Hello everyone, I hope so you will be fine. So guys, today we are going to discuss second topic, which is financial risk and return. And this topic belongs to the corporate finance section. So here we go guys. So first of all, we are going to discuss here a rate of return. It's very simple definition. What is rate of return? So actually, return, first I'm explaining what is return. Return is the amount received by an investor as compensation for taking on the risk of the investment. Like simply, when we invest, so whatever the amount we receive on our investment, that is your return. So there are two things. So one thing, if you want to calculate what is the return on investment, but this return on investment we are just calculating in dollar. So simply how you will calculate return on investment? So simply you will take amount received minus amount invested. So the difference of amount received and amount invested is your return on investment in dollar, I'm saying. Okay, for example, you have invested, just assuming 100,000, and you have received 110,000. Okay, like this is your total investment, this is your total receipts, for example. So the 10,000 which you have received in excess, so that is called what? Return on investment, but it is in dollar. So I'll explain also how you will solve the question. So guys, please remember, whenever you are trying to calculate rate of return, now I'm explaining rate of return. So rate of return, whenever you calculate, so simply it doesn't mean it's dollar. No, it's not a dollar. So whenever you calculate rate of return, it means you have to calculate percentage. So now please remember, so rate of return actually is the return stated as a percentage of amount invested. So like simply, once you will take this amount which is in dollar, and if you will divide with this amount invested and multiply with the 100, so you will get rate of return in percentage. For example, what is the formula here? Rate of return, how it is calculated? So return on investment means this amount, which was the difference of amount received and amount invested, right? So we'll take return on investment and we will divide with the amount invested and multiply by 100. So this will give you answer in percentage. So this is the first way, simplest way to calculate the rate of return. So let me first tell you the simple way, and then I'll explain other ways also, because I'll tell you how to solve the question. Then guys, for example, we have here example, an investor paid $100,000 for an investment. Like simply, investor has invested $100,000 and that returned 112,000. It means if you want to calculate, first of all, return on investment in dollar, I'm saying. Okay, so you will take simply amount received minus amount invested. Okay, so amount received is here how much? 112,000, and minus amount invested is how much? 100,000. Okay, so the difference will be which is 12,000, which is going to be your return on investment, but in dollar terms. So if you want to convert into percentage, like for example, now if you want to calculate rate of return, okay, in percentage, so then you have to take this, which is the return on investment in dollar, like simply return on investment in dollar divided by amount invested and multiply by 100. So how much return on investment in dollar is how much? 12,000, and 12,000. Okay, and divide with the amount invested. Amount invested is how much? 100,000, and multiply by 100. If you will just solve, so it will give you a 12%. So this is the simplest way. Now guys, I'm going to explain how you will solve in the question. Please remember, but if in exam question, so if he is asking you to calculate the return on investment, but in percentage, you have to calculate now. Okay, return on investment, or simply rate of return. Return on investment mean to say this percentage answer is also called rate of return. Okay, return on percentage. So if in your exam question he is asking you to calculate return on investment, and once you will see the option, for example, options are available in percentages. Okay, the option of the question. So it means now you have to follow this formula. So simply which formula? This return on investment ratio we studied in the part one also. So we'll apply this. We'll take operating income. Operating income means it's your profit, right? And we will divide with the average capital invested. Average capital invested multiply by 100. So this will give you answer in percentage. If in exam question he is asking you to calculate return on investment in percentage. Okay, so you will apply this formula. Sometime guys, sometime please remember. So this formula which is showing here, how this formula is derived. Okay, so sometime in exam question maybe he will ask you to identify which is the correct formula to find out return on investment, correct formula. Okay, so first you will look if options are written this way. For example, options are written operating income divided by average capital invested, so this is the correct formula. But sometime he might write this way also, please. And I'm going to tell you now the how this formula which I have explained here, how this formula is derived. Okay, so this formula can be written this way also, or I'm saying or. So same formula can be written this way also. How? So return on investment, how formula is derived? So we need capital turnover, capital turnover, okay, multiply by operating profit margin percentage, okay, operating profit margin. So now the point is how to calculate the capital turnover. What's the formula for capital turnover? So capital turnover is always calculated this way: sales divided by average capital invested. Okay, this is capital turnover. Multiply by how we calculate operating profit margin. We learned in the ratio section. So operating profit margin, how it is calculated? We always take operating profit as a numerator, and we always divide with the sales value. Now see, so this way he can also write. See, now return on investment can be calculated this way also. He can write this way, or he can write this way also: capital turnover multiplied by operating profit margin. And capital turnover can be written this way also: sales divided by average capital invested. And operating profit margin can be written this way also: operating profit divided by sales. Now if you will look at these two things, okay, this numerator and this denominator will be crossed, right? So and if you will just see what is the remaining formula. So remaining formula is operating profit as numerator and divided by average capital invested, right? So this operating profit and this average capital invested. So it means this is the same formula which is written here also. Understood? So you have to read the question very carefully, how the options of the questions are presented, right? I hope so it is clear, right? So one way, the first way I told you for return on investment, this I told you will take return on investment in dollar, which was the difference of amount received minus amount invested, right? And divided by investment. Investment means average capital invested, right? Multiply by 100. So this way it can be written, this way it can be written, and it can be written this way also. So you actually have to read the requirement of the questions, how the requirements are stated, and according to that you will answer the question. I hope so it is clear. So now guys, I'm going to explain some other concepts, and then at the end I'll solve some couple of questions, so you will get the idea how question will be tested. So now guys, here we are discussing now basic types of investment risk. Okay, so these are two very famous terminologies which are very famous in the field of finance. So one is called systematic risk. Okay, because these risk belongs to investment. Okay, so second is called what? Unsystematic risk. Systematic risk and unsystematic risk. Now let's understand, before moving to the systematic and unsystematic risk, let me give you example of diversified investment or diversification. So what is diversification, guys? For example, let's assume you have some saving with you. Let's assume you have saving of 100,000 with you, right? And I'm giving you option to invest your entire saving into company A's stock. You are going to invest into the stock of company A. entire saving. So what will happen if company A's stock will go up? Obviously, you will get gain, right? If it will increase in price in future, but if it will decrease in price in future, you will get a loss. So here you have a risk. Risk is what? The risk is that if you will invest your entire amount into one company, so you may have a gain on your investment, or you may have an entire loss on your investment, right? And this is what is the risky situation for you. Now, how you can avoid this risk, the risk of loss, how you can avoid? Okay, because this risk can be avoided. How? So now, for example, again, you have a saving of 100,000. Now you are more rational person, and you are saying that no, you won't invest into company A's stock. You will invest into company B also, C also. Maybe these companies belongs to different sector as well. Okay. So now what will happen? For example, let's assume 50,000 you have invested in A, or for example, or 30,000 you have invested in A, 30,000 you have invested in B, 40,000 you have invested in C. Now what will happen, guys? So if you will invest into different companies of different sector, what will happen? Maybe sometime one sector may go down, but on the other hand, other sector may go up in terms of stock prices, right? Maybe prices of stock may go down here and may go up here, and maybe may again go up here. So now what will happen here? Here you are incurring a loss on this investment, but here you have a gain. For example, here you have a gain. Now what will happen? So this loss can be netted off, can be compensated with this gain, right? And so you can get the average return. So actually this concept is called what? Diversification, or diversified investment, or diversified portfolio. Like diversified portfolio mean to say, when as an investor, if you have a, obviously you are a rational person, so you would not invest only into the stock or securities of one company. You will invest into the stocks or securities of multiple companies of different sectors. So the reason behind is so you can compensate your loss on one side, okay, with the gain on the other side, so you can get the average return. So this concept is called diversification, and this is the benefit of diversification, that the loss on one investment can be netted off against the gain on the other investment. Okay. Now now we will understand these two types of investment risk. So one is called, guys, systematic risk. So please remember, I quote the examples also. First of all, remember, systematic risk is also called market risk. Okay, so actually this is the risk which is faced by all firms. Okay, let me give you example. For example, if there is a economic recession, okay, in the, let's assume, in the country, so this economic recession will not affect only textile sector, or only maybe sugar industry, or maybe only cement industry, or maybe only oil and gas. No, so recession will affect all the companies. Okay, all companies will be affected by this risk. It means this is actually a systematic risk which is faced by all firms. Okay, another example. For example, if there is a war in a country, so this war will not affect only a specific sector. Okay, so it will affect all sectors, all companies, right? So, for example, if there is a changes in interest rates, so interest rates won't affect only a specific company, a specific sector. No, it will affect all the companies. Okay, all the sectors. Another example, for example, inflation, increase in prices, right? So if there is an inflation won't affect only a specific company. No, inflation will affect all the companies, okay, and all the sectors. So it means any risk which will affect all the companies. Okay, so that is called systematic risk. Now the point is that, so what is the next point of systematic risk? First, I told you systematic is the risk which is faced by all firms, and I quoted you four examples. I gave you example of war, I gave you example of inflation, I gave you example of interest rate risk, I gave you example of economic recession, right? So these all types of all examples are relevant to systematic risk, because these risks are faced by all companies in all sectors. Now what? Now point is that, so what is the second point? So first point was what? This risk is faced by all firms. Second point is that systematic risk, sometime referred to as undiversified risk. This is important point. Even, for example, if there is a war, even you will diversify your investment, even you will invest into different sector of different companies of different sector, so still you cannot get the average return. So because every company will suffer. Right or wrong? So that is why this risk is also called undiversifiable risk. Even you hold diversified investment, diversified portfolio, still this risk you cannot eliminate. You cannot eliminate. Now the point is that because these risks we will see in the future also, these risks also having relation with the specific models like capital asset pricing model that will link again there. But today I'm just explaining the definitions. Okay, so what is a systematic risk? The risk which is faced by all firms, and this risk cannot be diversified away even you hold the diversified portfolio. Okay, so you cannot offset this risk through the portfolio diversification. You cannot, right? So these 2 points are called what? Systematic risk. Now other type of risk which I'm going to explain, that is called what? Unsystematic risk. So please remember, unsystematic risk is also called non-market risk, because systematic risk was market risk, but unsystematic risk is a non-market risk. It is also called a company specific risk. For example, I'm just giving you example. So for example, if a government of your country will fix the export quota or maybe import quota for only textile sector, so this quota will affect only textile sector. It won't affect cement sector. It won't affect oil and gas sector, right or wrong? So this it means, so this is called company specific risk, or this risk is called unsystematic risk. Okay, because this risk is going to affect only specific company or maybe only specific sector, right? So other examples of, first example I told you, unsystematic risk, okay, which is called company specific risk, also non-market risk also. First example I told you, this risk will affect only specific company or specific sector only, right? So first example I gave you the quotas, like for example, if government will fix the quota. Other example is what? So this risk can be raised through the product. For example, if there is a automobile industry, maybe this risk can belong only to automobile industry, let's assume. Okay, so for example, then maybe leverage, degree of leverage, or maybe management competencies. For example, company A is having incompetent management. Okay, so it means this risk can be avoided if you will invest into another company who is having competent management, right? So this is what is unsystematic risk. It means unsystematic risk, first point I'm going to say now, unsystematic risk will affect only specific company or specific sector, not to the all firms. Second point, so this risk can be diversified away. Diversified away means how? So if you want to avoid this risk, so simply don't invest your entire amount into that company. Simply you should split your investment and you should invest into different companies. So it means the loss on this investment can be netted off on the gain on the other investment. So this is what is called unsystematic risk. So now the point is, so you have to remember the words. People are always confused about the systematic risk and unsystematic risk, right? What are their definitions? So definitions I have explained. So here I'm going to summarize one more time. So if there is any risk which is undiversifiable, you cannot diversify it away. Okay, so you cannot compensate that risk. So that is called what? Systematic risk. And this risk is faced by all firms. But any risk which can be diversifiable, that you can you can throw it away. Okay, and but this diversifiable risk is called unsystematic risk, and this risk is inherent in individual investment. Okay, like this risk is inherent in the specific company or specific sector, right? So this is what is called, this is what is the definitions. These are the definitions of systematic versus unsystematic risk. Now we are going to discuss other types of investment, also other types. For example, these are also other types of investment risks, so please don't forget. So one is called credit risk. So these kind of things we have already discussed also in even in other lectures. So but again, it's a kind of a repetition you have to remember. So credit risk is the risk that the issuer of debt security will default. For example, if you are a company. Okay, so you are issuing a bonds. Okay, you are issuing bonds, and I'm the investor, for example, in your company. So this risk I will face now. What? Maybe as a company, maybe you may default on interest payments. or maybe you may default on principal repayments, right? So this is what is called credit risk. So credit risk is what? The issuer of debt, means the company who has issued the bonds or debt securities. So they may default either on interest payment or on principal payments. So this is called what? Credit risk, right? And this risk can be gauged or can be checked by using ratings of your, of the securities. Ratings are there. For example, bonds might be triple A rated, double A rated, triple B rated, double B rated. So you should check first rating of the securities or of the debt securities, then you should invest, right? This is what is called credit risk. Then we have a foreign exchange risk. Okay, so foreign exchange risk, obviously, guys, for example, if you are dealing in foreign currencies, for example, you are, let's assume, Indian based company, okay, and you bought some goods from USA. You bought, okay, some goods from USA, and the price of the goods is fixed in dollar, for example, USA, and the price of goods is how much? $1,000. Now, guys, this transaction is on credit transaction. So today when you bought, for example, so the exchange rate was $1 equals, for example, 70 Indian rupees, for example. Okay, but you bought these goods on 3-month credit. If it means if you will pay today, so you have to pay 70,000 Indian rupees, right? Because $1,000 into 70 is the rate. So it means $70,000 you have to, 70,000 Indian rupees you have to pay to settle this transaction. But because this transaction is on credit and actual payment you will make maybe after 3 months. For example, after 3 months, so what happened? The rate became $1 equals 80 rupees, for example. Now what happened? It means now if you will settle this transaction of $1,000, so you have to pay $1,000 at the rate of 80. So 80,000 rupees you have to settle. So see how much you are losing. At the time of transaction, you have to pay 70,000, but because you are paying after 3 months, so now you have to pay 80,000. So 10,000 money you are losing, right? So this is what is why you are losing. Now you have to think you are losing just due to changes in exchange rate. Previously, $1 was equal to 70 rupees. Now $1 became equal to 80 rupees. So this is what is called foreign exchange rate. So simply, foreign exchange rate is the foreign exchange risk is the risk that a foreign currency transaction will be affected by fluctuations in exchange rates. Understood? So this is foreign exchange risk. Now we have other, obviously, if you are investing into foreign countries, so you may face this risk also. And if you are investing in the bonds, okay, you may face credit risk as well. Then we have another risk, interest rate risk. So let me give you example here. So interest rate risk, first let's read the definition. They're saying it is the risk that an investment security will fluctuate in value. This is the thing, that investment security, like simply market value of bonds, let's assume, even it might be stocks also. So let's take it bonds. So interest rate risk means to say the market value of the bonds will change. Why it will change? Due to changes in the interest rate. So let me give you example here. For example, guys, you invested in the bonds and that bonds offer you 3% interest. For example, the bonds market value, I'm just assuming, is, let's assume, $100. And how much it offers interest rate? 3%. It's a coupon rate on the bonds. But now in the market, interest rate has raised and interest rate is 5%. Now what will happen? Obviously, new companies will issue the bonds at 5%, but you are having bonds with the 3% interest rate. Now what will happen? So people will automatically withdraw their money, or people will divest their money from this investment, and they will try to invest into this option, right or wrong? It means when they are going to divest their money from this investment, which was at 3%, automatically if everyone will sell the bonds because they're offering only 3%, so what will happen? Market value of the bonds will decrease. So simply what happened now, you can just see here, interest rate risk is what? Interest rate is changing in the market, but it's affecting the market value of bonds, right? So this is what is called interest rate risk. Okay. So then we have here another risk. For example, another risk is what? Liquidity risk. So what is liquidity risk? Liquidity risk is what? It is the risk that the security cannot be sold on short notice for its market value. For example, I have a let's assume I have a even let's assume bonds, or maybe I have a stocks of a company which is not famous, let's assume. Okay, so now what happening, I'm trying to sell those stocks or bonds, but no one is ready to buy because that company is not famous, so people knows that if they will buy these stocks or bonds, so maybe it will be hard for them to resell in the future, right? So now I want to sell, but people are not ready to buy. So now what I have to do, obviously maybe I will offer them discount, right? I maybe market value is, let's say, $100. I will request them they can buy at $70. So this is what is the liquidity risk. Liquidity risk is what is the risk that security cannot be sold on short notice for its market value. You cannot sell at market value. You have to sell at you have to sell below the market value. So this is what is called liquidity risk. Okay. Then we have here financial risk, guys. This is actually a very broad word, financial risk. Financial risk, mean to say simply here, financial risk refers to the possibility of losing money. Like wherever you have, there are chances or there are uncertainty that you may lose your money on your investment. So that is financial risk, right? So financial risk refers to the possibility of losing money or experiencing a financial loss due to various factors. Like simply you may lose the money, that is financial risk. Okay, so they due to different factors could be what, factors could be market fluctuations, maybe due to changes in market, so you may lose the money, maybe changes in interest rate, you may lose the money, as I gave you give you example of interest rate risk, right? So maybe due to credit default you may lose the money, maybe due to operational failure of the company you may lose the money, maybe due to other external economic condition, maybe due to economic recession you can lose the money. That is called financial risk. So this is the keyword. Financial risk refers to the possibility of losing money or experiencing a financial loss due to different factors. Okay, if you are losing money or you are experiencing a loss, that is your financial risk. Then, guys, we have here purchasing power risk. Purchasing power, actually, this risk arises due to simply inflation. And inflation, it's a general increase in prices. That is called what? Inflation. So, what is purchasing power risk? I'm just giving you example. For example, I'm earning $1,000, and with this $1,000, I can buy. I'm just giving example. For example, I can buy 10 barrel petrol. For example, just giving you example. Okay, 10 barrel petrol, but still now petrol prices has increased. Okay, now what happened, petrol prices has increased. Okay, now I'm spending same $1,000, but I'm able to buy only 8 barrel petrol. Okay, 8 barrel petrol. So it means what happening, so this is what is purchasing power is, because I'm spending same amount, but I'm receiving less quantity of the product or of the goods or of the services. So this is what is called purchasing power risk, right? So simply purchasing power risk is the risk that the general rise in the price level, like increase in the prices, will reduce the quantity of goods that can be purchased with the fixed sum of money. So this is the words. So once prices increases, automatically you will buy less quantity of the product by spending same amount. Okay, that is what is purchasing power risk. Now, guys, we have here some other terminologies as well. So here we have, please remember, these are very simple things, but being a finance student, you have to understand these things. So now we are discussing relationship between risk and return. So guys, generally, there is always a relationship between risk and return. So obviously, in finance, we say if we are taking high risk, so we also expect high return. If we are taking less risk, we are also expecting less return, because return should compensate the risk taken by the investor, right? So this is what is generally, there is a relationship between risk and return. But the point is, so risk and return relationship, okay, also depends upon the attitude of investor. So investors, they have three different types of school of thoughts, or three different types of mindset. So some investors are risk averse investors, and some investors are risk neutral investors, and some investors are risk seeker investors. So risk averse, risk neutral, and risk seekers. Okay, these three types of attitudes are there, and according to their attitudes, so they always try to create risk and return relationship. So now, guys, let me explain here what does mean by a risk averse investor. So please, this is really important. Okay, risk averse investors. So risk averse investors, so let me give you first definition. So what is risk averse investors? We'll read first and then I'll quote the examples, because once we'll read, so we don't catch every word what they're trying to say. So risk averse, so people, what they have diminishing marginal utility for wealth. So what it means? Actually it means this statement, and this statement you have to understand. And what is this statement? So they are saying the utility of a gain for serious investor is less than disutility of a loss of the same amount. Actually, this is the definition of risk averse people. What's the definition? First, focus on word. The utility of a gain for serious investor is less than disutility of loss of the same amount. So let me quote the example here. For example, if you are a risk averse person, so let's you I'm telling you, so you are a person who are investing and you are having risk averse attitude. Now what? So for example, you got two options. So for example, on your investment, you may get a gain of $1,000. So if you are getting gain, so it means you are becoming happy, right? It's pleasure for you, right? Right. And other, you may lose money of $1,000. Okay, so it means it is pain for you. This is benefit for you, but this is pain for you, right? Loss is a pain for you. Loss is a pain for you. Please remember, if you are a risk averse person, risk averse, for you, you will give more importance to the loss and less importance to the gain. Right. So if this is the scenario, so you may have opportunity to make a money of $1,000, and you may have a opportunity also, okay, or you may have a chance of losing $1,000 as well. So in that scenario, if you're a risk averse person, so your main focus will be on the loss side and you will not invest, because risk averse people, they won't take risk and they don't want to take risk actually, right? So this is what it means here. Pain, for them, pain is more important than players. Pain of losing money is more important than pleasure of gaining money. So this is what it means. This is what it means, utility of a gain of serious investors. Simply the pleasure of gaining amount is less than the disutility of the loss of the same amount. Like simply, so as I told you, for them loss is more important. So maybe their pleasure is less, but pain is more if they will lose, right? So this is what does mean by risk averse people. So here you can just go through this example. According to loss aversion, it's a risk aversion, the people tend to feel the pain of losing something more intensively. Like if you're losing something, you will feel the pain more intensively than the pleasure of gaining the same thing. Okay, for example, as I give you example, if you are having $1,000 gain, or on the other hand, you may have loss of $1,000. So here, so the emotional and psychological impact of losing $1,000 is stronger than joy of gaining $1,000. So this is what is called risk averse person. Understood? And risk averse people, they don't take risks. So wherever they will see the risk, they won't invest simply. Okay, this is what is the relationship of risk with the investment now. So now here guys, we are discussing about risk neutral. So risk neutral people, actually, please remember, they always believe in mathematical calculation. And if you have remember, we studied expected value concept in part one. So risk neutral people, they always use expected value approach, mathematical approach. They always calculate the risk first. And if they think the calculations are in their favor, so they will invest. If they think so the calculations are not in their favor, maybe they will not invest. But they always use mathematical calculations. They don't use emotional or psychological impact. Okay, so they believe in the calculations, so that's why they use expected value. But risk neutral people, how it is defined in economics, so they're saying, so he or she regards the utility of a gain as equal to the disutility of the loss of the same amount. It means, for example, if if you are investing and you are gaining $1,000, okay, and if you're investing and you may lose the $1,000 also. On gain, you will have a gain pleasure, and on the loss, you will have a pain, right? So here, pain and pleasure both is equally important for you, right? Because you will do the calculation, and if you feel gain is more, you will invest, and if you feel loss, there is more chances that loss will incur, maybe you will not invest. So this is what is they're trying to say. So here, utility of a gain as equal to disutility of the loss of the same amount. Okay, understood. So they are having rational attitude towards risk. As I told you, they don't believe emotional and psychological impact kind of thing, so they always believe in the calculations, right? So for example, here is the example. If gaining $1,000, okay, provides the same amount of psychological benefit as losing of $1,000 provides psychological harm, so investor will make decision based purely on mathematical outcomes rather than on emotional biases. Understood? So it means for risk neutral people, gain or loss both are important, equally important. But for risk averse people, loss was more important than gain. Now we have here, guys, third kind of investors attitude, that is called risk seekers or risk seeking. Okay, so risk seekers investor has optimistic attitudes toward risk. Like you can say these are the gamblers kind of people, right? So gamblers, they always take high risk with the expectation of high return, right? So for them, what is more important? Let's assume, for example, you are gambling 10 euro. Okay, you know if you will win, for example, 100 euro. So you will gamble now because you know if you will lose, that is 10, but if you will win, so that is 100. So here you are more focused on benefit, not on loss, not on loss. What you are losing, that is not more important. So for risk seekers, the important thing is the benefit, how much they are getting. So this is how we can say. So he or she regards the utility of a gain as exceeding the disutility of the loss. For them, pleasure of gaining is more important than the pain of losing something. This is what is called risk seekers. And these are purely gamblers, as I told you. Okay, so this is what is these are three kinds of investors with different attitude. Now guys, we are discussing here financial instruments. This is just a list you have to remember. Financial instruments mean to say simply different types of investment options in which you can invest. Okay, uh, invest or in are those things, those securities which can be issued by the companies to raise finance. So we have a different instruments are available, and here if you will look at here, so this arrow, so here if you're moving this side, so it means you are moving from lowest risk to highest risk. And if you will look at here, rate means a return. It means if you're moving this side, so it means here you are having lowest return and here you are having highest return. Now look at here. Many questions can appear, guys, in your exam also from these kind of things as well. So please remember, so the lowest risky investment is US Treasury bond. And then more than US Treasury bond, the more risky investment is first mortgage bonds. And more than first mortgage bond, more risky is security mortgage bonds. Then more risky is subordinated debentures. Then income bonds is more risky than preferred stocks, then convertible preferred stock, then common stock. It means if now in exam, how they will ask the question, they will ask you uh, find the option with lowest to highest risk investment. Okay, or find the option with lowest rate to highest rate of return. Okay, so you should remember the lowest risk is US Treasury bond, then first mortgage bond is more risky than first treasury US Treasury bonds, then second mortgage bonds, then subordinated debentures, income bonds, preferred stock, convertible preferred stocks, and common stock. So you should remember all this story. Okay, guys. So now I'm going to show you questions and you will get the idea how question will be tested. So here we go. We have a question number one. So they're saying one type of risk to which investment securities are subject can be offset through portfolio diversification. This type of risk referred to as, please understand the question. The type of risk to which investment securities are subject can be offset through portfolio diversification. Like simply, guys, tell me uh, which kind of, like here we have four types of risk, right? Undiversifiable risk, liquidity risk, market risk, and unsystematic risk. So you have to tell actually in which risk you can offset, or in which types of risk is the definition of offsetting the risk through the diversification. So guys, I told you this is what is the unsystematic risk, right? Because unsystematic risk is the company specific risk. It is also called non-market risk, right? And this is the risk which we can diversify it away by having diversified portfolio. Understood? So undiversifiable risk is the systematic risk, because this is undiversifiable, but question is about diversifiable risk, right? Liquidity risk is something different, that you cannot sell the securities on a short notice without incurring a loss. This is liquidity risk. Market risk is a systematic risk, right? Market risk is the other name for systematic risk. So it means option D is the correct unsystematic risk. Then we have another question. So they're saying, which one of the following list properly ranks financial instruments in order from highest risk? Okay. Highest risk means say opportunity for return. Highest risk or highest return. Okay. To the lowest risk or to the lowest return. Simply you have to see, there are four options are available. You have to choose the option where high you are moving from high risk to the lowest risk. Okay, from high risk to the lowest risk, or from high return to the low return. Okay, so here we go. If you will go through first, for this you need to remember this actually list. I told you this list. This is the correct sequence. You have to find out the sequence now. Okay, from the option. If you're moving this way, like US Treasury bond, first mortgage bonds, second mortgage bonds, subordinated debentures, income bonds, preferred stock, convertible preferred stocks, common stocks. It means you are moving from lowest risk to the highest risk. So don't forget. So now we are moving to the question. So if you will look the option A, because you are moving from highest risk to the lowest. Highest is the common stock. So where common stock is first written, that is the correct option. That could be correct. So, okay, in three options, common stock is written first because it's the highest. It means option B is eliminated now, because in option B, he started with the preferred stock. No. And then he wrote the common stock. No. First common stock is highest risk. After common stock, convertible, but convertible options are not available. Then preferred stock, yes. Then income bond, yes. Then debentures, yes. Then mortgage bonds, yes. Then US Treasury. Actually, this is the correct sequence. Whatever out of available options, so this is the correct sequence. If you look at here, preferred stock first, then common stock, no, because preferred stock is less risky, common stock is more risky. But you have to find option from highest risk to lowest risk. Common stock, great. Preferred stock, great. Income bonds, okay. Mortgage bonds and debentures. Then US Treasury bonds. So what is the mistake here, guys? Mortgage bonds comes first or debentures comes first? Debentures comes first. Just go back and check. See here. Because I'm moving from here to here, na? From bottom to up. So debentures comes first, then mortgage bonds. So this is not correct. Okay, then next, common stock, yes. Preferred stock, yes. Debentures, okay. Mortgage bonds, okay. Income bond. No, income bonds should be here before debentures. Okay, so this is incorrect. So option A is the correct answer here. I hope so it is correct. Now we have your question, guys. So they're saying following information pertains to Andrew Company for the year ended 31st December. Okay, so we are provided with the sales, operating income, average capital investment, and then he told you which one of the following formula generates Andrew's return on investment. And now you have to look the option. Options are available in percentage? No. Options are written in terms of formula. I told you for return on investment, two formulas are there. Number one, I told you operating income divided by average capital invested. Second, I told you how this formula is derived. I told you capital turnover multiplied by operating profit margin. Capital turnover means what? Sales divided by average capital invested into operating profit divided by divided by divided by sales. So now if you look, so this is how it is written here. This is how it is written. So now you have to find which is correct option. So numerator should be sales, then average capital investment. So what is the value of sale? Sale is 720,000. It means it should be 720,000 divided by 480,000, because 720 divided by 480. Then operating income is available here 120,000 divided by 720,000. So this is the correct option. So 720 divided by 480. Where is 720 and 480? This is not 720 480. No. 720 480. Yes, this is correct. And then 120 divided by 720. Yes. Okay. So this is correct option C. I hope so it is clear. Not the D. Okay. Not the D because this is incorrectly written. So C is the correct option. I hope so it is clear. Then we have here another question. When purchasing temporary investments. Okay, so you're investing temporary. So which one of the following best describes the risk associated with the ability to sell the investment on in a short period of time without significant price concession? Can you see which kind of risk it is there, guys? This is the definition it's written. Risk associated with the ability to sell the investment in a short period of time without significant price concession. Which risk it is there? It's not a purchasing power because it's inflation. It's not an interest rate because interest rate risk is the risk that security will fluctuate in value due to changes in interest rate. It's not a financial risk. So it is which risk? Liquidity risk. Yes, liquidity risk, right? It's A. Yeah, this is the definition of liquidity risk. Liquidity risk is the risk that we will not be able to sell our investments in a short period without incurring a loss or at the market value, right? We cannot sell. We have another risk. Sorry, guys, this is answer is shown. Systematic risk explains. Okay, this is really important. Systematic risk is undiversifiable. You cannot diversify. Okay, so here first he told you systematic risk explains why. Diversification increase overall risk? No, diversification doesn't increase risk. It decreases actually. But systematic risk cannot be diversified. So it means this there is no concept, there is no question about diversification here under systematic risk because you cannot diversify it. So just it's incorrect. Stock value move in different directions? No. Diversification reduce overall risk. Okay, so but systematic risk is not diversifiable risk, so it is incorrect. Now, stock values tends to move in same direction. Actually, this is the correct option. Why? Because systematic risk will affect all companies, right? If all companies, for example, if there is a economic conditions are good, all companies stock prices will increase, right? But if there is economic recessions, all companies stock prices will decrease. For example, if there is a war, all company stock prices will decrease. It means stock prices will move in the same direction. This is correct, right? Either all will increase or all will decrease, right? So they will move in the same direction. So this is what is the correct thing. I hope so it is clear, right? So diversification risk explains why stock values tends to move in the same direction because these risks will affect all the companies, even positively or negatively, right? But risk is negative, right? We have another question. So question is, so this is kind of guys, we have discussed stock splits before, but this question was in this section, so I'm just discussing. So a stock began the year with stock price of 60 per share. Like at the beginning of year, stock price was 60 per share. In the middle of the year, it had a 3 for 2 stock split. I have so you have idea. 3 for 2 stock split means say your old two stocks will be converted into three new stocks. Or simply your old two stocks will be converted into three now. Okay, so that is stock split. So now they're saying stock ended the year with the price of 50 per share. Okay, this was the price per share at the start of year, and in the middle there was a stock split for 3 for 2. Okay, and at the end of year stock price was 50 per share, so no dividend were paid. What total return did investors earn on the stock during this year? So now guys, please, I can solve in different ways. So first I'm trying to tell you simple way. Simple way is what? Let's assume at the beginning of year. So you have two stocks because those two will convert into three in the middle of year. So you have a two stocks and each stock's price was $60. Okay, each stock price was $60. Okay, so each stock price was $60. It means the total worth was how much? $120. Now what happened? Because these two stocks are going to convert into three stocks, but value should remain unchanged. So it means now value is $120. Okay, for three stocks. So now what will happen? It means what will be the per stock price? What will be per stock price? So 120 divided by 3. So it means average stock price will be $40 because stock split we always do to reduce the market value. Okay, at the beginning of year it was $120 two stocks, because now these two stocks will convert into three in the middle of year and value will remain unchanged for three stock. It means average stock price will be 40. Okay, great. Now what? So but at the end of year what happens? Stock price is 50. It means the stock which is having worth of $40 in stock split, now it becomes $50 at the end of year. So how much gain you got? $10 is the increase in price, and this increase in price on your this investment, right? Now if simply if you will convert into percentage, what you will do? So you will take return which is $10 and investment value which is $40, multiply by 100. So return on investment will be what? 25%. Understood? A option. But if you feel this is difficult, then you can find this way, because in stock split 3x means a three shares value. Okay, 3 means a three shares, because it is going, two shares are going to convert into three, right? So three shares value should be equal to the value of two shares, because two shares at the beginning of year and stock price was 60, so total value was 120. Now this value should be equal to the three shares market value. Okay, so 3x equals $120 and x you have to find. X is the market value. So what you will do? 120 divided by 3. So it means one stock price will become 40. And at the end of year, stock price became 50. So it means from 40 to 50, there is a gain of $10. So now 10 is the gain divided by value was 40 in the middle of year and multiply by 100. So your return will be what? 25%. Understood, guys? I hope it is clear. Now, guys, we have here one more question. Just see. So they're saying risk factors, risk factors that cannot be eliminated through diversification, like any risk which cannot be eliminated. Okay, that is, systematic risk, right? Which of the include which of the following? Simply you have to find out here examples of systematic risk. Okay, that you have to find. So this is what they're saying. They're saying the risk factors that cannot be eliminated through diversification include which of the following? I told you interest rate risk is systematic risk because it will affect all companies. Inflation risk will affect all companies because general price level changes inflation. It will affect all companies. New product development, obviously it will affect only that company who is developing that product, right? It's company specific. It's diversifiable. Management turnover, obviously it will affect only that company from where people are leaving, not all the companies. So it means first two risks are can first two risks cannot be diversified. So it means one and two. So one and two is the answer of this question. Understood, guys? I hope so it is clear.